Have you ever wondered why your bank can lend out money it doesn't actually have? I mean, think about it. You deposit $1,000. You can see it in your account. You can withdraw at any time. But here's the crazy part. Your bank just lent that same $1,000 to someone else, and that person deposited it in their bank, which lent it to someone else. And now that original $1,000 has somehow become $3,000 in the banking system, here's what nobody tells you. The financial system doesn't work the way you think it does. Not even close. And understanding what's really happening behind the scenes will completely change how you think about money, banking, and the entire economy. Here at Simple Money, we've spent years breaking down how the financial system actually operates. And today, I'm going to reveal the mechanisms that most people never see. The invisible gears turning behind every transaction, the systems that create money, the networks that move it. This isn't conspiracy theory stuff, it's just how it actually works. And once you understand it, everything makes more sense. So here's what's really happening in the financial system. And I promise, this is going to blow your mind. Think about what happens when you swipe your credit card at a coffee shop. Seems simple, right? You buy coffee. Money moves from your account to the shop's account. Transaction complete. But that's not what actually happens. Not even close. Here's the real sequence. You swipe your card. The coffee shop's terminal sends a request to their payment processor. The processor contacts the card network, Visa or MasterCard. The network routes the request to your bank. Your bank checks if you have credit available, then sends approval back through the network. Back to the processor, back to the terminal. All of this happens in about 2 seconds. But here's where it gets interesting. No money moved. Not yet. That approval was just a promise. A hold on your credit line. The actual money movement happens later, usually that night. In massive batch settlements between banks. And even then, most of the time, no actual money moves. Banks just adjust numbers in their systems. Promises traded for other promises. And here's why this matters to you, personally, right now. Because this isn't how you think about money. You think money is a thing, a physical object that moves from place to place. But in the modern financial system, money is mostly just information, numbers in databases, promises between institutions, and understanding this changes everything about how the system actually works. Let me show you what I mean. Every day, trillions of dollars move through the financial system. But if you tried to do all those transactions with actual cash, you'd need trucks, warehouses, security. It would be impossible. So instead, the system runs on ledgers, banks keeping track of who owes what to whom. And at the end of each day, they settle up. But even the settlement is mostly just netting. If Bank A owes Bank B $1 million and Bank B owes Bank A $900,000, they don't move $1 million, they move 100,000. The difference. Everything else cancels out. This is what I call the ledger reality. And it's the first thing you need to understand about how big financial systems actually work. The ledger reality is simple. Modern money isn't physical, it's informational. It exists as entries in databases. When you get paid, numbers increase in your account. When you spend, numbers decrease. But nothing physical moved. Just information changed? Just ledgers updated? Here's what makes this so crucial. Because money is informational, the system can do things that physical money never could. It can move instantly. It can be in multiple places at once. It can be created or destroyed with just a database entry, and this creates possibilities and problems that most people never think about. Think about it this way. In the old days, if you wanted to send money across the country, you had physical options. Mail cash, wire gold, transport it yourself. All of these took time and had limits. But today, you can send money instantly because nothing physical is moving. Just information. Just ledgers updating in different banks. Your balance decreases. Their balance increases. The total hasn't changed, but the allocation has. And here's where it gets really interesting. This ledger-based system allows for fractional reserve banking. That's the thing I mentioned at the start, where your $1,000 deposit becomes $3,000 in the system. Let me explain how that actually works. Because this is the key to understanding how money gets created. You deposit $1,000. Your bank is required to keep a fraction of that in reserve. Let's say 10%. so they keep $100, and they lend out $900. That $900 gets deposited somewhere. That bank keeps $90 in reserve, lends out $810. That gets deposited. That bank keeps $81, lends out $729. This process continues. Each iteration is smaller, but it adds up. That original $1,000 creates about $10,000 in the banking system through this multiplication process. Now, you might be thinking, wait, that sounds like a scam. How can they lend money they don't have? But here's the thing. It's not a scam. It's the design. And it works because of one crucial assumption. Not everyone wants their money at the same time. Most deposits sit there. Most people don't withdraw everything. So the bank can safely lend most of it out. And as long as confidence holds, the system works. But this brings us to the second thing you need to understand, what I call the confidence game. The entire financial system runs on confidence. Not gold, not cash, not assets. Confidence. The belief that promises will be kept, that numbers in computers represent real value, that banks will honor withdrawals, that other institutions will settle their obligations. Remove that confidence, and the whole system can collapse in hours. Let me give you a concrete example. Silicon Valley Bank in 2023. They were fine on paper, had assets, had deposits, but people lost confidence, started withdrawing. And here's what happened. The bank had to sell assets to meet withdrawals, but those assets had lost value due to interest rate changes. So selling them created actual losses. Which scared more people? Who withdrew more? Which forced more asset sales? The death spiral. The bank didn't fail because they were fundamentally broken. They failed because confidence evaporated. Once people believe a bank might fail, they withdraw. Which makes it fail. It becomes self-fulfilling. And this isn't just about one bank. It's about the whole system. The entire modern financial system is built on the assumption that confidence holds, that people believe in the system, that institutions trust each other. Here's what makes this particularly fascinating. The system has created mechanisms to maintain confidence: deposit insurance, central bank backing, regulatory oversight. All of these exist primarily to maintain confidence, to make sure that even if problems arise, people still believe the system will work. Because belief is what makes it work. Think about the Federal Reserve. What do they actually do? At the most basic level, they're the confidence backstop. When banks don't trust each other to settle transactions, the Fed steps in. When financial markets panic, the Fed provides liquidity. Not because there's a physical shortage of money, but because confidence has broken down. And providing liquidity restores confidence, which makes the system work again. This brings us to the third critical mechanism, what I call the settlement network. Here's something most people never think about. How do banks actually move money between each other? You pay someone who banks somewhere else. How does that work? The answer is settlement networks. Invisible infrastructure that connects all financial institutions. And understanding how this works reveals a lot about how the system actually operates. In the United States, the main settlement system is called FedWire. It's run by the Federal Reserve. Every major bank has an account at the Fed. When Bank A needs to pay Bank B, they send a FedWire message. The Fed debits Bank A's account, credits Bank B's account. Settlement complete. This happens thousands of times per day, moving trillions of dollars, all through this central hub. But here's what's interesting. This central hub gives the Federal Reserve enormous power. They can see every major transaction. They control who participates. They set the rules. They can shut down banks' access. This isn't some decentralized system. It's highly centralized, with one institution at the center. And that institution has incredible leverage over the entire financial system. There are other networks too. SWIFT for international transfers, ACH for smaller domestic transactions, card networks like Visa and MasterCard. Each of these is a hub connecting different institutions, and each has similar centralized control. You might think of finance as distributed. Many banks, many institutions. But the infrastructure that connects them is highly centralized, with a few critical choke points controlling everything. And here's where this matters for you. Understanding this explains why financial censorship is possible, why banks can deny you service, why transactions can be blocked, It's not because of the individual banks necessarily. It's because the networks they depend on have control. And those networks can decide who gets access, what transactions are allowed, how money moves. The infrastructure itself has power. The fourth thing you need to understand is what I call the derivative layer. Most people think of the financial system as banks and accounts and loans. That's the visible layer. But there's another layer on top, a massive layer of derivatives. Contracts based on other financial instruments. And this layer is actually much bigger than the underlying system it's built on. Estimates suggest the derivative market is over $1 quadrillion. That's 1,000 trillion, more than 10 times the entire global economy. Let me explain what derivatives actually are, because they sound complicated, but the concept is simple. A derivative is a contract whose value depends on something else. An option to buy stock is a derivative. Its value depends on the stock price. A futures contract for oil is a derivative. Its value depends on oil prices. An interest rate swap is a derivative. Its value depends on interest rates. These are all contracts, promises between parties, based on underlying assets or indicators. Now, you might think, okay, so what? Why does this matter? Here's why. Derivatives create leverage. Massive leverage. You can control large positions with small amounts of capital. And this leverage amplifies everything. Gains become bigger, but losses become catastrophic. And because these contracts connect institutions, problems in one place spread everywhere. Think about 2008, the financial crisis. What actually happened? Subprime mortgages started failing. That's the story most people know. But that's not what almost destroyed the system. What almost destroyed the system was the derivatives built on those mortgages. Mortgage-backed securities, collateralized debt obligations, credit default swaps. These derivatives connected every major financial institution. So when the underlying mortgages failed, the losses rippled through the entire network. Banks didn't know who was exposed, who was safe, so they stopped trusting each other, and the system froze. The derivative layer is like a web connecting everything. Most of the time, it works fine. It allows risk to be distributed. It allows institutions to hedge. But when something breaks, that same web becomes a transmission mechanism. Problems spread instantly through the derivative contracts. What starts as a small issue becomes systemic. And here's what makes this even more complex. Most derivatives are private contracts between two institutions, not traded publicly, so nobody knows the full picture. Nobody can see the complete network of who owes what to whom. Regulators don't even have full visibility. This means the system is much more interconnected than it appears, with hidden connections through private derivative contracts creating systemic risk nobody fully understands. The fifth mechanism is what I call the credit creation machine. We talked earlier about fractional reserve banking, about how deposits get multiplied. But there's another form of money creation most people don't understand. Credit creation by the Federal Reserve itself. And this is where things get really interesting. Because this is how the government can spend more than it collects in taxes, how the system can expand during crises, how new money enters the economy. Here's how it works. The government wants to spend money it doesn't have, so it issues bonds, treasury bonds, promises to pay back the money with interest. Who buys these bonds? Often, banks buy them. But if banks don't have enough demand, the Federal Reserve steps in. And here's the magic trick. The Fed doesn't need money to buy bonds. They simply create it. They credit the government's account, and in exchange, they hold the bond. New money just appeared, created by a ledger entry. This sounds insane, right? The Fed can just create money? Yes, that's literally their job. They manage the money supply, and expanding the money supply means creating new money. Not printing it physically, just updating databases, adding numbers to accounts, and this happens constantly. Especially during crises. When the system needs liquidity, the Fed creates it. Out of nothing, just ledger entries. Now, you might be thinking, doesn't this cause inflation? Doesn't creating money reduce its value? Sometimes, but not always. And here's why. Money creation only causes inflation if it leads to more spending than production can support. If the economy can produce more goods and services, more money can circulate without causing prices to rise. It's about the balance between money and productive capacity, not just the amount of money. This is why the Fed can create trillions during a crisis without immediate hyperinflation. Because during a crisis, the economy is underproducing. Resources are idle. Creating money and pushing it into the system gets those resources working again. The new money doesn't chase the same goods, it brings new goods into production. At least, that's the theory. But here's where this gets politically charged. This credit creation machine means governments can spend without immediate tax increases. They issue bonds. The Fed buys them with created money. Spending happens today. The reckoning comes later. Maybe. If inflation shows up. If confidence wavers. But maybe not for years. This allows massive deficit spending, which sounds great until you realize that the bill eventually comes due. Either through inflation, which is a hidden tax, or through actual debt that future generations must repay. But here's what nobody wants to admit. This system is a feature, not a bug. During the Great Depression, the money supply contracted, banks failed, credit dried up, and the economy collapsed. Modern central banking is designed to prevent that, to ensure that credit always flows, that money is always available, that the system never seizes up. And it works. We haven't had a depression since the 1930s. We've had recessions, we've had crises, but not a full system collapse. Because the Fed can always create money, always provide liquidity, always keep the system running. The question is whether this creates other problems. Whether preventing depressions causes asset bubbles, whether constant credit creation distorts the economy, whether saving the system in the short term builds long-term fragility. These are legitimate questions, but they're separate from understanding how the system works. And the system works through credit creation, through central bank money printing, through expanding the ledger. Let me tell you about Tom. Tom thinks he understands money. He watches the news, he hears about Fed policy, interest rates, quantitative easing, and he has opinions. Strong opinions about what should happen, how the system should work, what the Fed should do. But here's what Tom doesn't realize. He doesn't actually understand the system. He understands the headlines, the surface level, but he doesn't understand the mechanisms underneath. He doesn't understand how ledgers work, how confidence matters, how networks connect, how derivatives amplify, how credit gets created. So his opinions are built on incomplete understanding, which means his predictions are usually wrong, and his financial decisions are suboptimal. Tom thinks the Fed printing money means hyperinflation is coming, so he puts his savings in gold, waits for the collapse. But it doesn't come. Because the money creation was offset by economic slack. Because the velocity of money decreased. Because the relationship between money supply and inflation isn't as simple as he thinks. His gold investment stagnates while markets recover. He misses gains because he misunderstood the system. Tom thinks banks are safe because they have insurance, so he doesn't worry about where he keeps his money. But he doesn't understand that deposit insurance has limits, that during system-wide stress, even insurance might not help immediately. That confidence matters more than insurance. He's surprised when people rush to withdraw from certain banks. He doesn't understand that the panic itself is the problem, that the system depends on everyone not panicking at once. Tom makes financial decisions based on incomplete models, and those decisions cost him, not catastrophically, but over time, the compounding effect of slightly wrong decisions is significant. He's a little too cautious in some areas, too risky in others. He doesn't optimize because he doesn't understand the system he's operating within. Now, let me tell you about Lisa. Lisa doesn't claim to be an expert, but she's curious. She wants to understand how things actually work, not just the headlines. So she digs deeper. She learns about fractional reserve banking, about settlement networks, about how the Fed actually operates, about how credit gets created, and this knowledge changes how she thinks about money. Lisa understands that bank deposits aren't actually safe unless confidence holds. So she doesn't keep more than insured limits at any one bank. She spreads risk. She understands that during crises, liquidity matters more than assets. So she keeps some cash accessible, not buried in the backyard, but not all locked up in illiquid investments either. She understands that the Fed will always try to prevent system collapse, so she's not betting on complete breakdown. But she also understands that interventions create distortions, so she watches for asset bubbles. for signs of misallocation. Lisa's financial decisions are based on understanding the system, and that understanding gives her an edge. She's not smarter than Tom, but she's working with a better model. She understands the actual mechanisms, so she can predict better, position better, protect better. Her returns over 20 years are significantly better than Tom's, not because of luck, because of understanding. Here's what most people don't realize. The financial system isn't random, it's not chaotic. It operates according to specific mechanisms that can be understood. And once you understand them, everything makes more sense. Why central banks do what they do. Why crises unfold the way they do. Why certain policies work and others don't. It all follows from the underlying structure. The ledger reality means money is information. The confidence game means belief matters more than backing. The settlement network means centralization exists even in seemingly distributed systems. The derivative layer means connections are hidden but powerful. The credit creation machine means money supply is flexible and politically determined. These aren't opinions, they're descriptions of how the system actually operates. And understanding these mechanisms doesn't just satisfy intellectual curiosity, it makes you better with money. You make better decisions about where to keep savings, about how much leverage to use, about which assets to hold, about how to protect against different types of crises. You stop fighting the system and start working with it. You stop making predictions based on should and start making decisions based on is. The system isn't perfect. It has flaws, fragilities, risks, but it also has remarkable resilience. It survived 2008. It survived 2020. It keeps functioning because of the mechanisms we've discussed. The central bank backstop, the confidence maintenance, the settlement infrastructure. These work, not perfectly, but well enough that the system keeps running, that transactions keep flowing, that money keeps moving. Most people never think about the plumbing. They just turn on the faucet and expect water. They swipe their card and expect payment. They check their balance and expect it to be there. And most of the time, it all works. The system functions. But understanding the plumbing helps you understand when something might break, where the weak points are, how to protect yourself when stress appears. The financial system is built on layers. Physical currency at the bottom, commercial bank deposits on top of that, central bank reserves above that, derivatives on top of everything. Each layer operates by different rules. Each layer has different risks. Each layer responds differently to stress. Understanding these layers means understanding how shocks propagate, where they get amplified, where they get absorbed. And here's the thing. This isn't secret knowledge. It's not hidden. It's just not taught. Most people learn about money from parents who don't understand the system, from school classes that teach basics but not mechanisms, from news that reports effects without explaining causes. So they operate with folk models, simplified mental pictures that capture some truth but miss the deep structure. The deep structure matters because it determines what's actually possible, what interventions work, what policies fail, what protections function. Folk models lead to folk wisdom, which is sometimes right, but often wrong. Understanding the actual mechanisms leads to actual wisdom, which makes you better at navigating the financial world, the ledger reality, the confidence game, the settlement network, the derivative layer, the credit creation machine. These aren't just concepts. They're the actual infrastructure of modern finance. The gears turning behind every transaction. The systems creating and moving and multiplying money. The mechanisms that determine whether the system runs smoothly or crashes spectacularly. Understanding these doesn't make you a master of finance, but it makes you literate. Financially literate in a way that most people aren't. You stop being mystified by what the Fed does. You stop being confused by financial crises. You stop making decisions based on incomplete models. You start operating with clarity, with understanding, with knowledge of how things actually work instead of how you wish they worked. The question isn't whether the system should work this way. Maybe it shouldn't. Maybe there are better designs. Maybe the risks are too high. Maybe the centralization is dangerous. Those are important questions, but they're separate from understanding what is. And what is a ledger-based, confidence-dependent, network-connected, derivative-layered, credit-creating system that somehow keeps functioning despite enormous complexity and hidden fragility. Once you understand that, everything else makes sense. The Fed decisions, the bank failures, the crisis responses, the policy debates, they all fit into a coherent picture, not a simple picture, but a comprehensible one. And comprehension is power. Power to make better decisions. Power to protect yourself. Power to navigate successfully through a system that confuses most people, but doesn't have to confuse you.